Is the banking system in danger from buying and holding on to too much gold and silver? Joining me today is Jeff Christian, managing partner of CPM Group, to talk about this very important issue. Jeff, welcome back to Kitco. It's a pleasure to speak with you today.
Good to talk to you. Yeah.
ETF holdings and flows this year are deceiving to the people who just analyze the surface, is what you've been telling me offline. Tell us how you're reading this data.
Well, if you look at the ETF holdings for gold and silver, there have been net additions of 27.9 million ounces of gold to gold ETFs so far this year. And most of it was March through July. And then there was about 332 million ounces of silver additions to ETF holdings. Now, a lot of people look at those ETF holdings and they say, well, this is investment demand. And most of it is investment demand most of the time. But if you look at those volumes, 27 million ounces of gold and 330 million ounces of silver, investors have never bought that much silver in a year in all forms physically. So those numbers just jumped off the chart. 27 million ounces for gold was high too. So we started looking at what was going on, and what we found was that really over the last 3 years, there's been a lot of gold and silver sold to market makers, bullion banks and dealers in London, in the London market. There's been a lot of investors over 2017 to 2019 who were selling gold and silver. And you saw inventories that the market makers were holding and that were reported in London rising to record levels. Now, the depository numbers that are now reported since 2016 include the ETFs, and it includes other stuff too. So it's not a good measure of the amount of gold and silver that the bullion banks hold. But they were at record levels in December already. Then when March came, there was a tremendous amount of gold and silver that was sold as investors raced to cash. And that metal came into the market makers, and there were not ready buyers there. And understand, this was at a time when a lot of banks' senior managements are saying, we want to get out of bullion trading, or we want to cut back on bullion trading severely. So even as the senior management was making the strategic decision to get out of bullion trading or cut back on it, the amount of gold and silver that they were holding on their balance sheets were rising to record levels. Then March came, and we've seen extremely higher prices, more metal coming into the market, being sold into the market makers' holdings, and very volatile prices. So we were looking at the ETFs, and we started asking questions. It was clear to us that some bullion banks had been taking gold and silver physical metal depositories and selling that in exchange for shares, newly issued shares of the ETFs. And so some part of that 27 million ounces and 332 million ounces of silver wasn't investment demand. It was banks disgorging physical silver and replacing it on their balance sheet with ETF shares. Then we realized that they were doing that because they were hitting value at risk limitations.
So as what you discussed reflected in the inflows of ETF, gold-backed ETFs this year, we saw a rise in inflows in March, and that's persisted throughout the summer, and it dropped off a cliff in August. Is that reflected in the story that you just told as well?
It's reflecting two different distinct things. The decline in August. One of the factors is, yes, investors have been buying a lot of gold and silver, and the investors were buying heavily in March, and then they pulled back a little bit, and then they picked up again. But in August, you saw a reduction for a couple of reasons. One was that the gold price rose very sharply to record levels. And some investors are price sensitive, and they were not buying gold at those record levels. They had bought earlier, and they pulled back. So one of the reasons why you saw reduced flow of money into ETFs and creation of new ETF shares is that the investors pulled back. And another factor that you're seeing in the decline in August is that the swapping by the bullion banks away from physical holdings to ETF shares had occurred earlier in June and July.
So Jeff, as you explained, the bullion dealers, the banks, have expanded their balance sheet with holdings of gold. Do you think that this has caused a liquidity issue for the banks?
It hasn't caused a liquidity issue. If anything, it is liquidity, but gold is perceived by banking companies and banking regulators as being less liquid than currencies. And it is, in fact, less liquid than the US dollar. So one of the things that you're seeing is not so much a liquidity issue, but just a value at risk issue in terms of the nature of the reserves across currencies and gold that the banks have as assets on their book.
Mm-hmm. Let's look at the central banks now. Over the last couple of years, we've noticed a trend of more central banks buying gold and adding to the gold reserves. Has that trend changed this year? Have you seen less or more buying from central banks in 2020, Jeff?
There's less central bank buying, and there are fewer central banks doing the buying. What we had seen for several years was that China, Russia, and Kazakhstan were the big three buyers. Russia has a number of issues. It's got sanctions against it from the United States. It has tensions with Europe. It has problems and tensions with Turkey. So Russia had been buying a lot of gold to keep the percentage of its monetary reserves that are in dollars and euros as low as possible. When the oil price war started between Saudi Arabia and Russia in April, and the price of oil fell, Russia stopped buying gold, and it hasn't bought any gold since April. China doesn't have the economic constrictions that Russia has, but it has been buying gold for several years and diversifying its portfolio. Gold is a very small portion of China's reserves, but they've been adding to it consistently. They pulled back, and they haven't bought any gold yet this year. If you look at the amount of gold that's been bought by central banks year to date through July, about 8 million ounces of gross purchases, and 7 million of that was from Turkey. The Turkish central bank is buying gold hand over fist, and it's buying it for several reasons. I mean, it has sanctions against it from the US, it has troubles with the US, troubles with Europe. The French and the EU have now opened a dispute because Turkey wants to drill in disputed waters off the coast of Crete for gas and oil. It has the Syrian civil war. It's got the Kurdish issues. It's got refugees pouring in. It's got a Cold War, let's call it a warm war with Russia, that's going on. Turkey has a lot of reasons to want to own gold. So the Turkish central bank has been buying gold, and Turkey has represented 7/8 of the gold that's been purchased. The other central banks, like I said, Russia pulled back because of the price war. A lot of other guys just pulled back because the price is rising. And central banks tend to be more price sensitive than private investors. So when you see the price rising, a lot of private investors will rush into it, but central banks will pull back. And when you see the price fall, as it did in 2015, 2016, central banks will step up and buy.
So would you say that their buying and selling activity could be a leading indicator for gold prices?
No, I wouldn't. Yeah, I mean, central banks are just they're more price sensitive than private investors. When the price falls is when they buy. The price doesn't fall because they're buying. The price doesn't rise because they're buying less. So it's not really a leading indicator. It's more the independent variable is the price. The dependent variable is the amount of gold that central banks are buying.
It sounds to me like a lot of the reasons that they're buying gold holdings is because they want to hedge geopolitical risks. In that case, why not just buy U.S. Treasuries?
Well, most central banks still own most of their foreign exchange and monetary reserves in gold. I mean, in the U.S. dollar. If you look at foreign exchange reserves, the U.S. dollar represents 62% of foreign exchange reserves held by central banks. So the dollar is still the preferred medium. You might want to get rid of it in the long run, but in the short term, the liquidity is there that doesn't exist in other currencies and it doesn't exist in gold. So central banks are committed to gold, to the dollar, if you will. But they also want to diversify insofar as possible.
So I've heard an argument that one of the reasons why central banks have been expanding their gold reserves is because of the movement towards de-dollarization, and countries around the world, for either political or economic reasons, want to diversify away from the US dollar and have less exposure to the US dollar and indirectly to the US. Do you think that's true?
It's true on a couple limited countries basis, on a short-term basis, and on a long-term basis, it's part of something different. It's not necessarily de-dollarization. On a short-term basis, you have pariah states like Venezuela, and to a lesser extent, Russia, and Kazakhstan sort of follows Russia's lead in this. And they have looked to reduce the proportion of their foreign exchange reserves that are in US dollars. On a longer term basis, most central banks would like to move to a multipolar international currency system. Not a gold-based system, the way gold bugs talk about, but a international currency regime where there's enough liquidity in the euro and other currencies that they can be much more competitive with the dollar. Not to replace the dollar, but to compete with it in terms of monetary reserve usage. But that's going to take a tremendous expansion of those other currencies, which has to take place over decades because otherwise it's hyperinflationary. And it also will require changes in national monetary regulations that would allow private entities to own deposits in currencies other than the domestic currency.
Here's data from the International Financial Statistics. It shows the countries with the top percentage of their foreign reserves held in gold. Number one is Venezuela with 84%. Number two is the United States with 80%, and then Portugal and Germany following that. Now, Venezuela's story makes sense to me. You just described it. Why is the U.S.'s percentage of gold holdings so high, or the percentage of reserves in gold so high?
Foreign exchange reserves or monetary reserves by central banks consist of foreign exchange, gold, SDR allocations, and membership in the IMF. And the last two are very small and inconsequential. Gold is about 10% of total central bank monetary reserves. The problem for the US is that the dollar is king. You know, it's 62% of monetary reserves on a global basis. It's probably 70 to 75% of private sector wealth. There's so much liquidity in the US dollar compared to other currencies. And the US government, by definition, cannot hold US dollars as foreign exchange reserves, right? It's theirs. So the US government, the Treasury, says if we have monetary reserves, we can have some euros, some pounds sterling, some Swiss franc, various other currencies, but the liquidity is not that big. And we don't quite need it. We do have 261 million ounces of gold, and that's sort of what we have to hold.
Do you think that foreign countries' holdings of US dollars versus their holdings in gold, do you think fluctuations in that percentage have anything to do with the relationship with the United States?
Absolutely. I mean, you see some countries like Turkey, Russia, Kazakhstan, Venezuela reducing their dollar exposure because they have hostile relationships. You have other countries saying, yeah, we have to hold most of our foreign exchange in dollars, but from a longer term perspective, we would like to diversify our portfolio. If you look at the Chinese government and the People's Bank of China and its purchases of gold over the last 10 years or so, most of those purchases were made from its current account surplus. They weren't tapping into the amount of money or dollars that they hold. They were looking at the constant inflow of dollars because of their trade surplus. And they were saying, we're going to take some of that monthly inflow of US dollars and convert it into euros, convert it into Thai bahts, convert it into other currencies of countries that we trade with, and convert some of it into gold.
So then, if you're looking ahead of the elections, do you think that the outcome of the elections either way would influence foreign policy going forward, and as a result, foreign countries' decisions to hold more or less gold?
Absolutely. I mean, we're working on a report right now on the implications of the election for gold and precious metals. And you have like 4 different scenarios on how things shake out. But definitely, I mean, this administration has excelled in its ability to reduce the U.S. stature around the world and to create hostile relationships with countries around the world. It's had a negative effect on CPM Group because there are people who don't want to deal with U.S. companies. And so I think a change in the administration, while it wouldn't be 180 degrees turn, because there are people in the Democratic Party, including Joe Biden, who will probably retain some sort of hostile posture toward China. It may be less hostile than the current one, and it may be less hostile toward Canada and other countries around the world. So you should see, if you saw a change in the administration and a change in the Senate, you should see some improvement in the U.S. relations with the rest of the world. But there's been a tremendous amount of damage done to the U.S. stature globally, and it's probably not going to get changed by a change of a government for 4 years.
Do you think the U.S. dollar then going forward could lose its status as a de facto reserve currency of the world? Could you see another currency challenging that status?
As I said, part of the problem is that the U.S. owes the world so much it owns it. We have 62% of monetary reserves. The U.S. dollar will lose its stature as the reserve currency in the future. The future may be 50 years from now, and it is reversible. This could not happen if the U.S. government got its act together, but I have no hopes for that.
Well, if the U.S. loses that status, what's going to take over? Who or what?
Yeah, well, I was getting to that. As I said earlier, most central banks in the world see as an ideal a multipolar international currency regime. They understand that it will take decades to get there because of the imbalance in liquidity between the dollar and all of the other currencies in the world. Yeah. 62% of their forex is in dollars. That means that there's only 38% in everything else. They have to slowly make that transition away. No government wants to see its currency replace the dollar as the reserve currency. What they'd like to see is a multipolar international currency regime where people are free and companies and governments are free, and there's sufficient liquidity in non-dollar currencies that you can own and hold a portion of your wealth in those other currencies, a greater proportion of it. No one, like if you talk to the Chinese central bankers, if you talk to other central bankers around the world, no one expects the dollar to disappear as a, quote, de facto reserve currency, but they'd like to see it disappear as the de facto reserve currency, but they're fully aware that this is something that's going to take decades to execute if it can be done.
Okay. You brought up China. I'm surprised to see that China was relatively low on the list when you're talking about their percentage of foreign reserves in gold holdings. It's only 4% of the foreign reserves in gold. Are you surprised at how low that number is?
No, I'm not surprised. I should ask you why you're surprised that it's high. But, China, the People's Bank of China for decades had a view that gold was a small and insignificant portion of its monetary reserves. It changed that view in 2015 at a time when it rolled out a massive acceleration of its efforts to make the RMB more of an international currency. It's still not, fully convertible, but they expanded the daily trading ranges and they expanded the longer term trading ranges that they found acceptable on the RMB. They started encouraging RMB bonds offshore, being issued offshore. And they said, okay, we're adding some gold to our reserves, and we're going to continue to buy gold because we see gold as a small but significant part of our monetary reserve policy going forward. Now, this was in 2015, and it's very important to understand that that was after 2008 and 2009, when the U.S. Treasury basically stuffed everybody else and protected the bankers or the executives at the banks in the U.S. And so this was a direct reaction to the inappropriate behavior that the U.S. Treasury had during the global financial crisis. And the Chinese central bank basically said, we have to accelerate our effort to help move toward that multipolar currency regime that we all would like to see in the long run. And so they started adding their gold. If you go back to 2015, they probably had about 1.1, 1.3% of their reserves in gold. So the fact that it's up to 4% and the fact that they have like $3 trillion of dollar reserve of foreign exchange reserves means that it's going to be a slow transition as they add gold to it. And as I said, they're very price sensitive. They pulled out of buying gold for about 15 months a few years ago. Then they came back and they were buying, but then they pulled back at the end of 2019 and they haven't reappeared. They've said, in the past, they said, we'll buy gold below 1,000. When gold went over 1,000, they didn't buy any gold for several years. Then they increased their threshold and they were buying. And then when the price started rising this year, they said, no, we're going to wait.
Finally, Jeff, with everything that's happened this year, and in particular with the central bank activity or slowdown of central bank buying activity, do you think the run-up of gold prices to $2,000 all-time highs has made sense to you? Do you think valuations are correct as they should be right now?
Yeah, I think they are. Obviously the trend over the next year or two is going to depend on several things. The outcome of the U.S. elections for the Senate as well as the presidency. Brexit is coming up. The pandemic, which is getting worse in Europe now and is expected to get much worse in the United States. There are a lot of negative factors there that fully support the idea of a $2,000 gold price now. I wouldn't be surprised to see the price of gold spike up higher on a short-term basis, then maybe plateau, depending on what happens politically. But we expect higher prices later, like 2023, 2025. Because none of these things are being solved.
Would you have a long-term price target in mind?
We're looking at a gold price that is very significantly higher than it is today.
All right, perfect, Jeff. Jeff, I want to thank you so much for speaking with me today. It was a fascinating talk. Thank you for your time.
Thank you for your time.
And thank you for watching Kitco News. We'll have much more coverage for you at the Denver Gold Forum. Stay tuned.